Please.
Business advisory committee. Exactly what you discussed.
You are the chairman.
I'm not allowing you.
Considering all these facts, senior citizens are not money bills.
What you are saying?
Balaji sir, मेरे को Prime Minister बनाओ बोलते।
No. Those schemes have been withdrawn.
बड़ा ही दुर्व्यवहार किया।
Well, finally, some clarity on the M.A.T issue. It may not be enough. And finally, the government manages to get some legislative business done. The finance bill has been ratified by Parliament. Good evening. Thanks very much for joining us on India Business Hour. That's our top story tonight.
In case of FIIs, profits corresponding to their income or capital gains on transaction in securities which are liable to tax at a lower rate shall not be subject to M.A.T.
The government stands its ground on the M.A.T row with FIIs. The finance minister says foreign investors will not be taxed on profits from the sale of shares in India from this fiscal. Investments in the debt market will also get the reprieve, but the finance minister refuses to provide any retrospective relief.
It has therefore been decided to delete the PDMA provisions from the finance bill for this financial year.
The finance minister also deletes the provisions of the finance bill to create an independent debt management agency. Money market oversight to stay with the RBI for now, but the finance minister reiterates the RBI cannot manage the money market, says it will be in conflict with its inflation targeting mission. The government tweaks some tax proposals made in the budget. Export duty on select iron ore slashed to 10%. Customs duty on raw silk also cut to 10%, but customs duty on rubber hiked to 25%. With 5 days to go, the government gears up to push its legislative agenda. The land bill, GST bill, appropriations bill will all be taken up by Parliament next week.
We call this, as compared to 2014, which was a long-only kind of environment, this is a perfect long-short kind of an environment.
The ongoing correction is a good time to buy, says Samir Arora of Helios Capital. This even as the bears tighten their grip on the Lal Street expiry jitters shave off over 200 points from the Sensex. India's infrastructure output growth contracts 0.1% in March. This is the lowest growth rate in 18 months. Steel and cement are the major culprits for the full year. Core sector output grows by 3.5% against 4.2% in FY14. Roaming is all set to get cheaper from tomorrow as telecom companies slash tariffs following TRAI's diktat. SMS rates slashed by 75% and outgoing calls will be cheaper by 20%. And our continuous coverage of the agri crisis, a ground report from the Jalna district of Maharashtra, where farmers are struggling to get the right price for their produce. Also on the hour, Nokia is reborn as Microsoft devices. We check into the world's first ever priority reseller store that's opened in the national capital. But first up, the correction continues on the Lal Street, and the expiry day provided just enough ammunition for the bears in trade today. In early trade, the Sensex tumbled below the 27,000 mark for the first time in almost 4 months. But then we saw a fight back in late trade, and the Sensex did pare some of those losses, but it still ended about 200 points lower. The Nifty also saw some wild swings and lost about 60 points, slipping below the 8,200 mark. Mid-caps managing to outshine the blue chips once again, with the mid-cap index ending with marginal gains. How long will this correction last, and is this a good time to enter the market? Samir Arora of Helios Capital says we may not see a rally like last year, but Ramdev Agarwal is confident that the markets will outperform in the long run.
We have increased our net exposure a little bit by 5-7%, but my bigger picture thesis remains that some sectors are quite okay and you can say good, but some sectors are very bad in terms of a stock market expected performance. And therefore, we call this, as compared to 2014, which was a long-only kind of environment, this is a perfect long-short kind of an environment.
A lot is going to happen in the next 12 months. So I would not be pessimistic on the market per se, and I would not think that markets are going to go on 13-14 P multiples. I mean, probably we have corrected to a good level, maybe to some more corrections, but I would remain bullish on a slightly. On a 1 year basis, of course, it will be very difficult to say anything, but on a 4 year basis, I mean, this term of this government, I would remain fully booked.
Well, expect volatility and short-term pain, but in the long term, the story continues to look good for India. Top market voices there. Shifting focus now to the currency, where the rupee, just like the Indian equity markets, did shake off some of the early morning jitters, but ended the week in the red against the dollar. Month-end dollar demand from importers and capital outflows from the markets, ensuring that the rupee ended at 63.42 to the dollar. But the big story this evening, the finance bill has been passed by the Lok Sabha, but not before some key amendments were introduced by the finance minister. On top of the list is the issue of foreign investors and the minimum alternate tax imposed on them. Now, presenting his final defense of the finance bill, the finance minister tweaked some tax provisions. The contentious MAT, or minimum alternate tax, goes, but it goes only prospectively, and this will apply not just to equity investments but also debt investments. However, retrospectively, it continues to be effective on FIIs who are now fighting it out in court. However, the finance minister said that MAT will not apply to earnings from royalties and technology fee. More importantly, MAT will also not be applied on the sale of units of REITs or real estate investment trusts. Let's listen in to the finance minister.
Deferment of MAT with regard to REITs and InvITs. Finance Bill 2014 provided for tax neutrality in respect of exchange of share of a special purpose vehicle with the units of business trusts. However, no neutrality deferment of MAT liability was provided. The liability under the MAT may arise due to recording of exchange of shares with the units at a fair value in compliance with the provisions of notified accounting standards by a shareholder being a company. This may result into cash flow problems for the company. In order to address the issue, I propose to provide for exemption from levy of MAT on gains and losses arising out of exchange of shares with the units of business trusts, REITs or InvITs. The liability under minimum alternative tax will arise only on actual transfer of such units. MAT on foreign companies. The Finance Bill 2015 proposes to provide that in case of FIIs, profits corresponding to their income or capital gains on transaction in securities which are liable to tax at a lower rate shall not be subject to MAT. There is, however, an old dispute which is pending in the Supreme Court. Considering the various representations received subsequently and the fact that certain incomes are taxed on gross basis in case of foreign companies, I propose to provide that amount of income accruing or arising to a foreign company from 1. Capital gains arising on transaction in securities, 2. Interest, royalty or fees for technical services chargeable to tax rate, then.
Well, that's the finance minister clarifying the amendments made in the finance bill with regards MAT. We'll get you details on what this really means. But expect the tax department to issue more tax notices to FIIs and FPIs. Speaking exclusively to CNBC TV 18's Rituparna Bhuyan, Revenue Secretary Shaktikanta Das has said that the taxman will continue to do his job and the ongoing court case will not stop him from sending further notices. However, he also added that the total demand will be far, far lower than the 40,000 crore rupee figure that was doing the rounds.
What the finance minister has done is that apart from FII investments in securities, there are other kind of foreign entities who get other kind of income from India, like interest income, then income from the royalty, then fees for technical services, where the normal rate of tax is less than 18.5%, which is the MAT rate. The finance minister has announced that in such cases the MAT will not be applicable.
Is it true for both debt and investment related FPIs or just only a particular set of FPIs?
I am talking about such income of the FIIs or FPIs which are less than the MAT rate, like royalties, interest receipts, and fee for technical services.
Yeah. My last question to you is that there were stories saying that the demand could go up to 40,000 crore. Is that a figure that has come out from thin air? What according to will be the max demand that could arise out of this issue?
What will be a total figure? I can tell you that. I mean, I don't want to guess the number, but yes, 40. I mean, it's far less than what is being talked about outside.
Quick response. More notices to go out, or will you wait for the court order?
No, the legal process has to go on. We cannot withhold the legal process. But when the matter came up in the Supreme Court yesterday, even from the government side, the Attorney General said that government is also prepared for an early hearing, and government is also keen on an early hearing so that the matter is resolved.
Okay.
And that is what the Finance Minister also said in the House.
So no more, notices only after the legal process is complete? I mean, that is what everyone would want to do.
The existing processes will have to go on.
Right.
You know, we cannot presume what the order of the Supreme Court will be. We cannot presume. The normal process has to go on.
Well, the legal process will continue. That's the Revenue Secretary. Remember, today, 5 FPIs have moved the Bombay High Court. Joining us now to discuss the implications of the amendments made by the Finance Minister in the Finance Bill is Sunil Kapadia, Business Tax Leader at EY. So thank you very much for joining us on India Business Hour. Let's start by the MAT clarification. It's a mixed picture there. I wasn't expecting any retrospective exemption or retrospective correction. I don't know if you were. So if you were, then there's disappointment on that front. But on the business of exemption on technical fee, royalty and interest income, at least there's some relief on that front.
Yeah, Shirin, I think you are correct. However, the relief is only prospective in nature. It's still not retrospective. And therefore, one will have to see what happens, whether the tax officers will issue notices even in respect of royalties or fees for technical services. I think the other point which will need consideration is what happens if there is a treaty benefit allowed on fees for technical services and royalty. You know, how will that get treated under the new law? I think so. That's, I think, the other issue that one would have to sort of grapple with. And I think the third is that yes, there was an expectation that one could have provided by way of a clarification on this issue, that if something is already taxed on gross basis under the provisions of the Income Tax Act, MAT would not apply. You know, that would have solved a lot of cases where tax withholding has already been done under 115A on royalties and fees for technical services under the Act.
Right. So those are some of the issues that remain not clarified. But let me ask you this, because it seems now, and that seems to be the view of the government, that this is a matter that will find its conclusion in court. You heard the Revenue Secretary there saying that the government is in favor of an early hearing as far as the Supreme Court is concerned. Today, we've actually seen 5 FPIs move the Bombay High Court. And the Revenue Secretary also saying that we're going to go about doing our business and we will be sending out tax notices till we actually see a conclusion on the legal front. So do you really anticipate this ending anytime soon?
No, I think you are right. The Castleton case, as far as capital gains is concerned, will decide the fate of capital gains. And I think based on whatever happens in Castleton's case, especially the issue as to whether foreign companies are required to prepare a profit and loss account when they do not have a presence in India, you know, that aspect will have to be appropriately dealt with, and one will have to wait as to what Supreme Court says on that issue.
Right. I also want to get your comments in on the other comment that the Revenue Secretary made on CNBC TV 18, saying that this rumoured 40,000 crore rupee figure is far exaggerated and the actual liability could be much lower. Our sources tell us 6,000 to 7,000 crore rupees is what the government is looking for. Also, are you disappointed with the fact that the treaty benefit clarification which was expected was not made in the finance bill?
No, I think the rounds that have, at least what we have seen in the press and the media reports, is 600 crores based on the current number of tax notices issued.
That have already been completed.
Yeah,
68 entities and the assessments that are completed.
Correct. No, yeah, that's true. And I think the point also is that, whether one would see notices for the back period of 6 years, wherever there are capital gains, and one still doesn't know what is the amount that can arise out of that. We've seen media reports and tax and press reports saying that something is likely to come even for the back period of 6 years.
That's right. But this carve out being extended to things like private equity now, how much of a relief is that going to be? Albeit all of this is of course prospective.
So what is now provided is that capital gains to a foreign company, and again, there is a definition of securities as per Section 2H of the Securities Contract Regulation Act, which is relevant, will not be subjected to MAT on a prospective basis. So yes, when a private equity, if it is coming as a foreign company, invests in India in an unlisted security, that security would have to be a security covered by 2H of the Securities Contract Regulation Act for it to avail the benefit of MAT exemption on a prospective basis.
Okay. Speaking of MAT exemption, what do you make of the clarification that's come in with regards to REITs and investment trusts? Because these are things that haven't taken off so far. Do you believe that finally they could see the light of day, given the clarification that's come in on the exemption of the MAT levy, at least on time of creation?
You are right, Shirin. The concern really of the promoters or the sponsors of the trust, business trust, was that, when they exchange their shares of the special purpose vehicle for REITs, there would have been only a notional gain, and that would have got taxed in absence of this clarification. With this clarification, at least, I think the process of the sponsors wanting to look at REITs and business investment trusts would definitely gather some momentum now. I think what has also been clarified by the finance minister in the speech is that when the final units which the sponsor gets in exchange of his shares in the SPV, once they are sold and the capital gains is realized, it is at that point of time that MAT would have to be looked at.
Okay, so good news coming in there, at least as far as REITs and investment trusts are concerned. My final question to you, Mr. Kapadia, before I let you go, at the end of this, now with the passage of the finance bill and these clarifications being made by the finance minister, do you believe that there's going to be much calmer nerves in the boardroom, or do you believe that the nervousness will continue?
So on a prospective basis, yes, there will be a lot of calming of the nerves in various boardrooms. And therefore, when people start, investing afresh, at least there will now be certainty and clarity on taxation as far as MAT is concerned. But yeah, if someone has done transactions in the past and there are capital gains or other sources of income, one would have to still wait and see how the notices come and, what emerges out of the, the verdict of the Supreme Court in Castleton's case.
Absolutely, and the applicability of what the Supreme Court verdict is in the Castleton matter. Always a pleasure speaking with you, sir. Thanks very much for joining us on India Business Hour to decode the implications of the clarifications by the Finance Minister. Well, these were not the only amendments brought in by the Finance Ministry. In what will come as good news for the iron ore mining companies, the Finance Minister has slashed the export duty on iron ore from 30% to 10%. This could lead to iron ore prices rising domestically, which is of course bad news for steel makers. Meanwhile, the basic customs duty on rubber has been hiked to basic customs duty on rubber from 20% or 30 rupees per kilogram, whichever is lower, to 25% or 35 rupees per kilogram, again, whichever is lower. Additionally, the Finance Minister has also assured the Parliament that a new simplified income tax return form will be released shortly. Remember the controversy over the last one. This after he had to step in and put the ITR forms on hold after receiving a lot of criticism for being too cumbersome and tedious. The other big story, the government has also put off its plans to create an independent debt management agency. Now, all 6 provisions of the finance bill over the creation of the debt management agency have been omitted or deleted. Speaking in the Lok Sabha today, the finance minister said that the RBI cannot be the debt management authority, as that will be in conflict with its inflation targeting mandate. However, he's added that the centre will come up with a new roadmap after close consultations with the central bank.
As the members of the August House are perhaps aware that the proposals of a separate the management of government debt from RBI was first mooted by the RBI itself in its annual report 2000-2001. Subsequently, several independent committees have recommended the establishment of an independent debt management agency equidistant both from the government and the RBI. The Percy Mystery report of 2007, the Raghuram Rajan report of 2009 have both strongly argued for separating the debt management function from the RBI. The recommendations are, I must say, well-founded. Continuation of the RBI as a public debt manager, or for that matter a regulator of currency and other derivatives, 1, fragments the bond market in India, limiting its liquidity. 2, creates a conflict of interest between the RBI's role of controlling inflation. Since the RBI has been handling public debt management, the government, in consultation with the RBI, will prepare a detailed roadmap separating the debt management function and the market infrastructure from the RBI and having a unified financial market. It has therefore been decided to delete the PDMA provisions from the finance bill for this financial year.
So what all of that essentially means is, for now, the RBI's powers remain untouched. Now, separately, provisions relating to moving regulation of the government securities market to SEBI from the Reserve Bank have also been dropped. So for the moment, money market oversight will remain with the RBI. In fact, CNBC TV 18's Lata Venkatesh had written about the issue. She even went on to say that taking these powers off the Reserve Bank and burying the amendments as part of the finance bill is a fraud on the Constitution. She joins us now. Lata, finally, good sense seems to have prevailed.
There were two specific powers of the Reserve Bank which were being whittled down by the finance bill. One, its merchant banking role, merchant banker to the government. That is, the government every year sells about 6 lakh crores of securities. That is sold by the Reserve Bank. The conduct of the sale is done by the Reserve Bank. The other role is that it regulates the government bond market. The finance bill had announced in its miscellaneous provisions that amending the RBI Act to say that the government securities market will be regulated by SEBI. Today, the finance minister pulled back both these. He did not give any reasons, but merely said that they will be introduced as separate acts later on, both the PDMA Act and as amendments to the RBI Act or in some other fashion. Chances are that it has been withdrawn because of the impropriety of putting them in the finance bill. Chances are, the argument is that only money bills are passed in the finance bill, and over a money bill the Lok Sabha has no power. But in amending the RBI Act or the PDMA Act, the Rajya Sabha has the same power as the Lok Sabha. So putting these bills in the finance bill was improper, and that perhaps was the reason why it was removed, although the finance minister didn't give any reasons. However, he said that these are going to be introduced in the next fiscal. So if this is an instance of bringing down the RBI's powers, this battle is only postponed, it's not ended.
All right, it looks like the Reserve Bank's powers are intact for now, but the finance minister did clarify that they will draw up a roadmap in consultation and take those powers away. So the finance bill is passed. The centre is all now set to take up the GST bill and the land bill next week for debate and passing in Parliament. Speaking in the Lok Sabha, the finance minister also took the opportunity to attack the opposition once again on the land acquisition bill. He said political obstructionism is hurting the economy.
When the global economy is facing a slowdown, India being one of the bright spots, if we can put our house in order and put an end to the politics of obstructionism of economic change or making India an attractive economic destination, and if state after state compete with each other, they all will add to the national growth rate.
Well, the land bill, despite all the hesitation, will be taken up on Tuesday as per the government's plans. Now, green shoots remain elusive for the economy. Core sector growth in March is contracted to its lowest rate in 18 months. Infra output in March contracted by 0.1%, with the steel and cement sectors being the major culprits. For the full year, growth is at 3.5%. Even this is significantly lower than the 4.2% growth rate clocked in FY14, so it's not looking good there for the economy. The finance minister has also accepted the fact that the current agrarian crisis is a very grave one. Assuring the Lok Sabha, he said the central government is trying to do all it can to address the issue. But as CNBC TV 18's Archana Shukla has been reporting, unseasonal rainfall, low produce and disparity in prices are just some of the problems plaguing farmers. As part of our ongoing series, What's Ailing Rural India, CNBC TV 18's Archana Shukla has been travelling through Maharashtra. Today she travels to the APMC market in the Jalna district in Maharashtra. And what did she find there? Well, take a look.
Bad monsoons have meant no crops, which means farmers don't really have anything to sell. And it was pretty evident when we visited the APMC market in Ambar Taluka in Jalna district. Streets were empty. There were only very few stores where farmers were selling some of their produce. And even there, their anguish as regards the minimum support price for grains and grading of grains while selling was very evident.
किसानों को क्या कर रहे हैं सब व्यापारी लोग हैं, जो आड़तिया लोग हैं, वो 4 क्वालिटी में माल खरीदी करते हैं, और 2 क्वालिटी में बेचते हैं। समझो ग्रेड कर रहे हैं उसके, 4 ग्रेड में खरीदी कर रहे हैं और 2 ग्रेड में बेच रहे हैं। किसान का लॉस जा रहा है उसमें। तो ये महत्वपूर्ण बात है और ये 2 ही ग्रेड में माल खरीदी होना चाहिए।
अच्छा,
हाँ, जैसे आप बेच रहे हैं ना बाबा, वैसे ही खरीदी होना चाहिए।
1201 2
रेट डिफरेंस की वजह ये है कि जो माल बनाने का जो अवेयरनेस जो है किसानों में वो बढ़ना चाहिए। उन्हें भी उनकी क्वालिटी के बारे में इन्फ्लुएंस क्या उनको जो ये लेना है, जो मेहनत लेनी है उसके ऊपर, उसकी पूरी जानकारी चाहिए।
41 रुपया।
ये प्रोसेस है बोली लगाने का, ये किस हद तक सार्थक होता है किसान को सही भाव दिलवाने में और मार्केट में सही भाव पर? 100% है आपके हिसाब से? क्योंकि बहुत तरह के हम लोग सुनते हैं कि एपीएमसी का जो ये प्रोक्योरमेंट का प्रोसेस है, जो बोली लगाने का प्रोसेस है बेचने का, इसमें बहुत ऊपर नीचे होता है, किसान को सही भाव नहीं मिलता।
बड़े बड़े मार्केट है वहाँ होता होगा, इधर तो नहीं है। सबसे बड़ी बात यह है यहाँ पर मार्केट ओपन है। यहाँ पर अगर किसी को, अगर किसान को लगता है कि मेरे माल को सही दाम नहीं मिल रहा है, तो वो रोक भी सकता है, मुझे माल नहीं देना है, आज नहीं बेचना है, वो कल भी बेच सकता है। ये मार्केट की, ओपन मार्केट की ये सबसे बड़ी फैसिलिटी है।
One very pertinent thing that we saw in this district Jalna's procurement center and the center here for APMC is that because of low produce in this year, there is very little and very few farmers have actually come here to sell their produce. Usually villagers say that at this part of the year, this place is buzzing with activity, buzzing with farmers trying to sell most of their produce over here. But if we go around and have a look, most of the traders and merchant stores are shut, and most of the traders and merchant stores do not have farmers here selling their produce.
Failing crops and falling produce, that's the story across large parts of the country. On that note, it is time for us to wrap up this edition of India Business Hour. Remember, the markets are shut tomorrow, so it's been a truncated trading week, but we'll be right here with all the news on CNBC TV 18. So stay tuned to us through the day as we get you all the action.